Bloomberg Audio Studios. Podcasts, radio, news.
I'm excited for today's episode. I'm only really excited to talk about search funds, if I'm being honest.
Because I want to get straight into your future as a HVAC technician.
Yeah, I was reading this article as a guide, you know?
Right. The appeal of the search fund is that, like, who among us hasn't wanted to own a lucrative HVAC business in New Jersey?
Just run into the swamps of New Jersey and get into waste management. Wait, that's a different thing.
It's a similar thing.
It is similar.
No,
I was talking about
there's all these
in the Sopranos way.
Yeah, right.
Right.
Hello, and welcome to the Money Stuff Podcast, your weekly podcast where we talk about stuff related to money. I'm Matt Levine, and I write the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
Wouldn't that be a great story, though, if you're like some 28-year-old Harvard MBA and you're like, I'm going to start a search fund, and you scour the earth and you send cold emails to a bunch of people and you end up getting into the waste management business in New Jersey, and you're like, oh, great, now I can like be my own boss and like run this lucrative business, and then like the mob shows up?
Yeah, surprise. Yeah, now you have many bosses and they'll kill you. I'd never heard of search funds before.
Really? I read about it all
Even as a dedicated Money Stuff reader, I guess I never absorbed it. But I was so charmed by this piece. This is probably the longest article I've read in a long time, but I read it start to finish in Business Insider.
Right. There's a Business Insider story about search funds. I love search funds so much because search funds are like, if you get a business degree from a fancy school, the highest calling could be running a duct cleaning business, or I always say pest control. Like pest control to me is the archetypal search fund. I don't know if it's actually that common a search fund use, but basically, right. A search fund is like you go to business school, you graduate, you raise a like 6 or 7 figure fund from investors. The investors, I think, are often like your family, but sometimes are professional investors because the returns on search funds are really good. And then you go out and search for years to find a boring small business whose somewhat aging owner is looking to get out of the business and sell to some young whippersnapper. And then you buy it, and then you run it, and you use the tips and tricks that you learned in your 2 years of business school to like optimize it. And you're like a little private equity kingpin, except instead of being like an associate at a big private equity fund, it's just you. And instead of like rolling up a giant business, you like buy one pest control company and then you run the pest control company. It's so good.
It is so charming. And I mean, reading this Business Insider article, okay, so it's told through the lens of this man, Dan Schweber, I believe his name is. And I mean, I thought that I deal with a lot of rejection as a journalist. Being a search fund founder, what do you call them? Just a search funder?
Searcher.
A searcher?
Did you say searcher? Yeah.
Being a searcher sounds absolutely grueling in terms of dealing with the word no. By the end of it, he sent 3,600 initial emails, 375 introductory calls, just 30 intro meetings, and 6 signed letters of intent. And this business that he ended up buying, which is an HVAC company, he emailed the guy 12 times, as you pointed out in your column. And I don't think I've ever made it to the 12th email. Like, I don't think I've sent 12 emails to the same person pitching them, which is, I don't know, it was inspiring. It was inspiring on so many different levels, Matt.
How persistence pays off by getting you an HVAC company.
Exactly. If I just send a dozen emails, maybe I can own an HVAC company.
Well, what I love about it is that this was a sort of novel idea at some point, 20 years ago, and it is now really like pervaded the top business schools so that a lot of people are doing this, which means that if you run an HVAC company, you are constantly getting cold emails from searchers. And so, like, of course you had to email the guy 12 times because the guy was like, more search funds.
Yeah.
It is such an amazing time to be in an unglamorous business because there are so many people with MBAs who want your unglamorous business, right? A lot of them are searchers, but some of them are like private equity funds doing roll-ups of like pest control or whatever, right? Like there are a lot of buyers to choose from if you happen to own an HVAC company. And I don't know. It's just so strange to me to think like you're a plumber. You like work in plumbing for 20 years. You start your own plumbing company. You like go around doing plumbing. And then like you occasionally check your email and there's like 400 emails from private equity firms and MBAs. It's just like a strange dynamic.
It's a seller's market. I wish I had a plumbing company to sell.
Right. And like one thing I wondered about is like if you are a search funder and you buy yourself a plumbing company, in a year do you flip it to another search funder because like the demand keeps growing?
I do want to talk about that, how you exit it as a searcher, but you seemed charmed by it, particular from getting into the shoes of the man who owned this HVAC company. The article also got into the shoes of the employees who worked there. I think that's another interesting level. Like, okay, yeah. The founder and owner of the business is getting a bunch of emails. How do the employees react when you tell them this 32-year-old now owns the business and you work for him and he's the CEO and, you know, he's some Harvard MBA?
Okay, here's how I think about this. I think in the olden days, people would start businesses and they would be like, you know, high school educated, like, you know, they start a business because like they're just scrappy entrepreneurs. And then they would run the business for a while and they'd have employees and they would have like a kid. And they would be like, well, of course, the kid is going to take over the family business. But because they're rich now, instead of like the kid just like, you know, starting at the family business after high school, they send the kid to Harvard Business School. And the kid gets all these like newfangled business ideas. And he comes back at age 28 and he's like, I'm going to take over the family business and run it in a modern way. And like, you know, that's good, right? Like you have like the scrappy founder and then you have the next generation is like professional and educated. But the chain has been broken. So now like the founder gets rich and the kids are like, well, I don't want to work at the family HVAC business. That sounds terrible, right? So the kids go off and like become documentary filmmakers. And meanwhile, like it's really hard to get into Harvard Business School now. So you can't just get into Harvard Business School by being the like shiftless child of an HVAC founder. But all the people in Harvard Business School, you know, there's still a demand for Harvard MBAs to run HVAC companies. So now instead of it like being the kid of the founder, it's just like some random person who happened to get a Harvard MBA and now wants to run the, you know, HVAC business in Peoria. So it's disaggregated the like family, you know,
the family business.
Family heir. Yeah. Instead of like the son taking over the family business with his fancy Harvard degree, it's like some random person takes over the family business with his fancy Harvard degree. But, you know, it's like still kind of the same. It's like the employees still have to work for a 32-year-old who hasn't worked in HVAC. You know, it's like it all makes a kind of sense. It's just become more like coldly logical and market driven.
Something that I kept thinking about while reading this article, for some reason, a meme that keeps popping into my various algorithms is, you know, cartoon guy, hand in his face in the middle of the circle. And it's like, I meet a girl, her dad owns like a $20 million a year, like waste management company or pest control or something. But he doesn't want to like hand the keys to his ambitious future son-in-law. And then we stop talking, which it would be a lot funnier if I could show you the meme, but I promise it's funny. But it kind of reminded me of this.
Sure.
Anyway, I thought also it was interesting, you know, this article described it as a phenomenon happening around like late 20-year-old and like graduates in their 30s. And I think it speaks to something about millennial culture that there is that desire to run into the woods or go to Peoria and run an HVAC company versus stay in a city and try to climb the corporate ladder. Like this probably happens with every single generation, but it does feel like it speaks to some sort of disillusionment.
Yeah. I mean, I don't know. You think about like what you can do with your MBA, right? Like if you're a sort of corporate type, like you can go work in private equity and you can start by building models and doing kind of grunt work. And your hope is that in 10 or 15 years, you'll be, you know, kind of leading big deals and sitting on boards of companies and kind of running portfolio companies. Or you can just do deals and run companies yourself immediately, with the trade-off being that those companies are small pest control companies in Peoria. But like, maybe that's a good trade, right? Like maybe you want that trade, right? Like I'm sure that in like 10 years, you'll be reading about people who started as search funders and bought like one HVAC company and then bought another HVAC company and then became like billionaire private equity kingpins by like doing roll-ups of their industries. There's kind of two paths to that outcome, right? There's like the outcome of being a private equity associate, and there's the outcome of taking over an HVAC company. And I bet the second path is more likely to get you to the like billionaire kingpin outcome at this point than like being a private equity associate.
Well, I think you have to have some ridiculous amount of just self-confidence or unearned ego to think like, I'm going to go in and I'm going to CEO this small company like it hasn't been CEO'd before.
Yeah, you're like a little bit more confident, a little bit more risk-taking. You're not like just following the expected prestigious path of going to a private equity firm. You're like, I'm going to strike out on my own and see what happens. Well, it's interesting because like also in 10 years, this will be such a like well-trodden path. There'll be like incubators for search funds and like it'll be so standardized that it won't be like particularly entrepreneurial and risky anymore. But right now it's still a little entrepreneurial and risky.
So you're saying I should get in now is what I'm hearing.
I don't know. I was going to say you should have gotten in 5 years ago. I have no idea what the market is like. I think you shouldn't get in 10 years. But yeah, get in
5 years ago was the pandemic.
I think this is great. I feel like we've had a number of like career ideas for each other during the course of this podcast. But you you raising money from friends and family to take over an HVAC company, I like it. I didn't know that you had such an intense interest in HVAC.
Not specifically HVAC.
No,
I know that we're using that.
You were a horse barn, but
yes, that's the thing.
I don't know if that works. I think like the whole point of this is that you're taking over like non-glamorous family businesses from like aging founders who don't want to do it anymore, not like people's like delightful lifestyle businesses. But
I don't know. There's plenty of people who would think that a barn is unglamorous.
Do any of them own barns?
No, you're right. They don't.
That's your problem. You have to buy the barn from someone who owns the barn.
I don't know. I'm reading this. I have like a renewed, I'm reinvigorated. And, I thought I wanted to be a podcaster. I did that. It's okay.
Yeah, sure, right. No,
I wanted to be a novelist, still working on that. But I think that what I really want to be is a searcher. I've always wanted to buy a dressage barn, but now I have a fancy, not yet saturated sort of term to apply to it.
Yeah. I mean, that is really like the thing about the search funding is like, it's given people a set of concepts to sort of standardize and think about and justify this thing of like, I want to buy an existing small business and run it according to my own, ideas. I think like a while ago, if you were in business school and you're like, I want to run an HVAC company, people would be like, that's a strange thing to want to do with your Harvard MBA. Whereas now it's like totally standardized. I was like, oh, of course, a search fund. And similarly, I feel like this is going to be like season 2 of the podcast is going to be, you're going to go to investor meetings. We're going to record them. People are going to be like, of course, here's $1 million. You're going to send out cold emails to every horse barn in America.
At least 12.
So at least 12. Yeah.
If anyone listening right now.
You won't cold email, you'll show up on a horse.
That's true. I'll ride in town. And they'll know I'm the real deal. They won't turn me away and say, yeah.
That's like one thing in this HVAC article is like, the guy who owned the HVAC company was like, all these search funders emailed me and I was like, all right, come out. And they're like, let me check my schedule. But this guy, the guy who bought the company from him was like, I'll be there tomorrow, right? You're going to show your enthusiasm by like showing up on a horse.
That's the other thing I found charming is that it's just like old fashioned sort of, I'm going to come up and meet you in person. I'm going to shake your hand and I'm going to look you in the eye. And that has a lot of currency with the people who are selling these unsexy businesses.
Right. Because these are people who have built businesses over years and they are the owner, but they also like work closely with the employees and they are not just maximizing shareholder value. And if they were to sell to a private equity firm that laid off all the employees, they'd be sad. And like they live in the community, they'd be looked down upon. So if they can sell to someone who gives them a firm handshake and looks them in the eye and says, I'll take care of your employees, it's a very family business oriented, kind of deal making environment. And you're not just paying the highest price to maximize shareholder value. You're kind of taking over a business that has ties to a community. Yeah.
I do want to talk about how Schweber is going to get this big payout that Business Insider says that he's in for. So if all of this goes according to plan, he's in for a big payout of the search entrepreneurs who eventually sell their business. Just under a quarter of them get nothing. Another 27% get less than $4 million in equity. 28% get $4 million to $10 million. The luckiest 18% get more than $10 million. So, after I buy the horse barn, I have to stay there and make it better and grow it. And then the idea is that I'm going to sell it in like a decade and make a big profit.
I have to imagine some people go into it thinking like, I'm going to make my life in Peoria running an HVAC company. But most of them are like business school people and like they're choosing between this and private equity. And yeah, they want to do a flip, right? They want to like buy a sleepy family business that isn't, optimizing everything. And they want to spruce up the financials and maybe do a few like tuck-in acquisitions and then sell it to a sort of more scale buyer, sell it to, a private equity roll up or something for, if you can buy it at like 1 times revenue and sell it at, 5 times revenue, then they, make a lot of money.
And so the investors who
and then you do it again, or you retire or something. I don't know.
Or you become an investor in search funds.
Sure.
So if you invest in a search fund, you're in it for the long haul. You're in it until there's a flip.
I don't really know the terms, right? Like you could imagine, the investors just getting a share of the cash flow and being happy with never flipping it. But no, most of them want to cash out. And yeah, you're in it for a flip. And, you say the long term, I don't know what the holding periods are, but like, again, the sort of alternative to this is private equity funds. And so, yeah, you might think, I'm going to take over an HVAC company. I'm going to learn HVAC. I'm going to do some deals. I'm going to spruce things up. That won't take me more than 5 years until I can flip the company, right? Like it's not necessarily your family business for the rest of your life.
I have to imagine a lot of these fail.
I don't know. I don't know what fail means. I mean, right. Like probably some of them, they don't spruce them up and then they get bored and then they're like, all right, we're shutting this down and I'm going back to New York. But right. Like you're taking over like a stable business with customers and, you're not founding a business, right? Like your downside is not as bad as if you were founding a business from scratch, right? You know that this company already has a business and customers and, revenue and employees, and probably in many cases it could operate on its own without much from you. So you might not be able to do a flip. You might like get bored and close it down rather than eke out a very small profit for yourself every year, but like you're not going to like lose all your money.
Yeah, that's true. I mean, to your point that they're not founding a brand new business, I was thinking about this in terms of like, maybe these smart young people with these big degrees, maybe their brain power would better serve the economy by putting that towards new ideas.
Why though? Like,
well, that's where I ended up.
Their degrees
Why?
are not in astrophysics, right? Their degrees are masters of business administration, right? They've learned to administer businesses. I think it's like a really good thing for the economy if like the local sort of mid-sized businesses get really good business administration, right? If like the Harvard MBAs, instead of just going to work in finance, like actually go and work for real companies that do, HVAC.
This reminded me, I know these people who, there was a bed and breakfast for sale in a small Pennsylvania town, really charming. And it was an existing business with existing customer base who they had a lot of repeat customers. And the owners were retiring and they bought the business and it's going really well.
And those people are named?
Bob and Julia. And Friday is my dad's birthday. So happy birthday, Dad.
Happy birthday, Bob. I meant to tell you that I saw someone like
my cat is coughing. Hold on.
That's you, okay.
That is me.
I mean, it's your cat. It's your worthy soundproofed home studio.
Jesus, cat.
That sounds terrible. Do you need to go to the vet?
No,
We're keeping all of this in.
It's literally a hairball. He's fine. He's fine. Windsurf, man.
Elsewhere in buying companies.
Yeah.
Buying family
but
businesses.
not really buying the company.
Well, kind of.
Set the scene.
Windsurf is like an AI coding assistant company. And
of course.
It was in talks to be acquired by OpenAI for a while. the rumor was that OpenAI was going to pay $3 billion to acquire it, which I think means to acquire it in the normal way, like buy all the stock of the company. But they couldn't get to an agreement on some weird terms, including like sharing the technology with Microsoft. And so OpenAI walked away. And then Google did this weird deal where it paid $2.4 billion to Windsurf for basically like some, but not all, of Windsurf's employees. Like basically Google was trying to acquire like the top talent from Windsurf to feed into the maw of like having AI researchers do AI at Google. And they've got like a non-exclusive license to Windsurf's product, but it seemed pretty clear that it was a talent acquisition. But they didn't buy the company. They got no stake in the company. But the shareholders of the company mostly got cashed out. Like the venture capitalists got paid off for their stock. So Google paid for the stock of the company, but didn't acquire the stock of the company. They just got the talent and like left the company on its own. And this is kind of a weird outcome, in particular for the employees of Windsurf who didn't go over to Google, because they were kind of left in this like company that had some cash and like a business, but no more of its founders, and was kind of like at loose ends. And then like a couple of days later, Cognition, another AI company, bought the rest of Windsurf for an unspecified price that like might have been just like, here, you can have a job. And so, yeah, that was the deal. It was like quite controversial. There's been a lot of deals kind of like this in the AI space where, you know, you have very big tech companies that want to pay a very large amount of money for AI talent. And the top AI talent often has their own startups. And the startups often have the effect of proving that their founders are good at AI stuff, but do not have products that the big tech companies want. And historically, the way that ended was the big tech companies would buy the startup, shut down the product that they didn't want, and like give the employees jobs. But that has changed. Like that acqui-hire model has changed. And I don't quite know why. Like the leading theory for why it has changed is that in the Biden administration, there was a lot of antitrust scrutiny of big tech companies buying even small startups. And so they stopped doing acqui-hires and started doing just hires.
Yeah.
But the other thing that is happening is if you're Google or Meta or whoever, it's sort of dawning on you like, well, we don't really have to acquire the company. We just have to pay the founders to come work for us. And we have to pay them a lot because they have this startup and they have equity in the startup. So like they have to give up the equity in the startup. So we have to pay them a lot. But like, do we need to acquire all of the employees? Do we need to pay the VCs the full value of the company? Or can we just like acquire the founders and like let the rest go? So there's a lot of talk about like the social contract of startups and VCs being violated by these deals. And I feel like so far, actually, the social contract holds up pretty well, where like the VCs who funded Windsurf, you know, they got several times their money, right? Like they got rewarded for funding Windsurf, even though I think people would say, in a sense, like the product isn't what's making the money. It's just like the founders are going somewhere else is what's making them the money. But, you know, and the employees ultimately ended up with jobs, although not at Google. So like the social contract sort of held, but it's like, it just feels like it's a little bit under pressure where like, you know, the next deal, Google could just be like, we're going to pay the founders, you know, $1 billion each, and we're not going to cash out the VCs.
Yeah. Reading this and just thinking about similar circumstances, my thought was, why don't they just try to poach people the normal way? Like, why is tech this special weird place where there is acqui-hiring? Like, why can't they just offer the founder $100 million or something like that, similar to what Mark Zuckerberg is doing? Why do we have to go through all the hoops of, you know, buying the company or doing whatever Google just did?
I think that part of it is like you can now pay AI researchers $100 million, but you can't pay them $500 million because all the other AI researchers would be mad. And like, if they have a startup, you know, that has raised money at a $4 billion valuation and they own, you know, whatever, they own they own $1 billion worth of it, right? You have to lure them away from that startup by giving them a lot of money. Maybe it's not $1 billion. Maybe they don't think it's worth what, you know, what it raised at, but you have to give them something like $1 billion. And the way to do that is to have some sort of M&A-like transaction, right? Like if you're just saying, I'm going to give you a salary of $1 billion, that's tough to sell to your other employees. But if you say, I'm going to do an M&A transaction that technically doesn't involve buying any of the company, but like there's a licensing deal and it's like an agreement with Windsurf, then you can do a transaction that effectively gives the founders $1 billion, right? And so I think that's part of it, where like the going rate for poaching an employee from like OpenAI to Meta is, $100 million. But the going rate for poaching a founder of a startup that like was valued at a lot of money by a VC, the going rate for that might be billions of dollars. And the only way to pay that is in something that looks like an M&A transaction.
Mm-hmm. The other thought I had was that there is still some acqui-hiring going on. If you think about the recent example of also Meta with Scale AI.
No, these are all the same thing. Like these are not quite acquisitions.
Yeah.
Sometimes they're like stake acquisitions, but not 100% acquisitions. And sometimes they're more like the Windsurf deal where it's like a commercial license and a big payment, but not 100% acquisition.
Yeah. I was just thinking about the employees who didn't get picked to go to Google. And that's probably a pretty lousy feeling. But maybe they're happy at Cognition.
Yeah, but it's like there's this incredible gold rush for AI, and there's incredible variance in people's perceived market value, right? Like there are people who are, there are people who are multi-billionaires because they like were in early in AI. And then there are people who are paid like, $600,000 a year and they're like, oh my God, I'm so poor. Like there's a huge range. And some of that is the sort of classic startup, like were you there at the founding of a hot company? But some of it is like people's perceived value to the big tech companies where like if you are really, really good, a big tech company will pay you, much, much, much more than $100 million if they have to. And then if you're less good, it's like, yeah, you're on salary. It's fine.
Mm-hmm. And where we are in the world right now, I mean, is this uniquely a tech industry phenomenon and specifically an AI industry phenomenon?
Even in tech, people have normal jobs. Like this is very localized to AI. Like there are not these kinds of bidding wars for people who do non-AI tech business.
Man, if I had any practical skills, I'd be thinking I need to be an AI person somehow. But I think search fund founder is probably more realistic.
You're looking more horseborn.
Yeah. You know who else is in the business of buying up a lot of companies?
Is it the Vanguard Group?
It's Vanguard. They are an index fund company.
Yeah.
All the companies. As much as Vanguard likes to talk specifically to me and everyone else about their, active management ambitions, they are huge. That means that they own a lot of the shares outstanding of a lot of companies, including companies that you might not expect.
I would expect. Wait, can I ask you, are they the biggest total stock market index fund?
Oh my God. I think
that's right. Because Vanguard runs, a big S&P 500 index fund, and so does everyone else. But I definitely own some of the Vanguard Total Stock Market Index Fund, which is not the S&P 500. It's everything, including small companies and including Bitcoin treasury companies.
I'm trying to find out because I don't want to misquote myself, but I think that the Vanguard Total Stock Market Index Fund is the largest.
It's like the only one I know of, yeah.
It's in the trillions, so
right.
I would imagine that that's it.
So when you say Vanguard is one of the biggest shareholders of companies you wouldn't expect, I would expect them to be the biggest shareholder of every single public company. Mm-hmm. That's what I would expect. And they are.
Including Strategy.
In particular, I'd expect them to be one of the biggest holders of every non-S&P 500 company. Because there are a lot of S&P index funds, but Vanguard is really into total stock market index funds. But anyway, they're the biggest holder of Strategy, MicroStrategy, now called Strategy.
I guess I did not appreciate that Strategy isn't in the S&P 500, but we're also talking about a non-S&P 500 tracking fund because, I don't know, it just feels like increasingly the whole world revolves around the S&P 500. But the Vanguard Total Stock Market Fund, biggest shareholder of Strategy, I say that you might not expect it because the personality of Vanguard is an asset manager that is deeply, deeply skeptical / repulsed by cryptocurrencies.
I know, but this is the thing about running an index fund. It's like, it doesn't matter what you think. You just buy it.
Yeah.
It's like a really good disciplining mechanism, right? Like you can sit around and be like, well, I think this company is overvalued, but it doesn't matter. You have to buy it because you're an index fund manager. And that's what people are paying you for. And they're not paying you very much, right? Like if they're paying you a lot, then you might be like, well, I'm going to short this company because I think it's overvalued and I'm, getting paid a lot for my wisdom. But they're paying you 2 basis points to buy every company. So you buy every company. It's a really good business. I love it.
The thing that's slightly different here is that Vanguard obviously has control over what products that it launches.
Yeah, but its products are index funds.
I know. But this is a relatively new phenomenon where you have equity companies that just hold Bitcoin. And you think about commodities, for example. Vanguard, for a long time, would not launch a commodities fund. They're never going to launch their own cryptocurrency fund. And okay, yes, they're going to buy every single stock out there, but it's a new phenomenon where that means you're also buying crypto indirectly.
Yeah. One of the things I like about it is that, this is a little inside baseball, but not really. Bloomberg has this view that you shouldn't own stock in companies that you write about. So I don't own stock in, Goldman or Apollo or whatever, but I own index funds and they own stock in those companies. And so I have exposure to those companies. Right. And in some ways it would be weird if I didn't, right? To me, I should have my savings in the global financial portfolio. And if I owned all of the stocks except Goldman, then in theory, that would create a financial bias against Goldman. I would be like, well, I don't own any of their stock, but I own every other stock. So I want their stock to go down relative to the rest of the market. And then crypto is kind of the same, right? We have sort of rules that you shouldn't own crypto if you're writing about it. But if I own zero crypto, then I'm sort of biased against crypto, right? I own all of these stocks and I want the stocks to go up, but I don't want crypto to go up because I don't own any crypto. But now, because I own the Vanguard Total Stock Market Fund, I own some Bitcoin indirectly, but I have some exposure to Bitcoin through strategy. And I think more generally, it is good for ordinary investors to be able to get low cost access to market cap weighted ownership of the entire global financial portfolio, right? Just as it's probably good for you to not have to pick which stocks will go up, but just buy all the stocks. You shouldn't even have to pick which asset classes will go up. You should just be able to be I'm going to buy the market, right? And you can't really do that. It's not really a thing. People try, but it's not really a thing because how do you decide how much real estate to have in that? But by smuggling a little Bitcoin into your, total stock market fund, it means you have a little bit closer to exposure to the entire financial portfolio. And if you don't like crypto, you'll be mad about that. But if you're buying the total stock market fund, your thesis has to be, I don't know what I want to buy. I have no strong views about which companies will go up. So have some Bitcoin. Why not?
Yeah. Occasionally, Tom Keene invites me on radio and just kind of bullies me about crypto for a couple minutes, and then I get off air. And
is he pro or anti?
I would not describe him as pro crypto.
I'm not surprised. Yeah,
he famously calls it bit dog. But in trying to make him care, I have tried to make the case that you should care because it's probably in your retirement account through this sort of indirect exposure. Your fortunes, in a small way, are tied to Bitcoin now.
Right. I would reverse that. I would say that if you don't have a strong reason to be short crypto, you should be long crypto in proportion to its weight in the market, right? And that weight has gone up a lot in the last 10 years, right? It's now trillions of dollars. And if you are just completely on a blank slate, completely agnostic about everything, your weight should not be zero. And now it's in your retirement fund. Great, problem solved. I'm not saying you should buy crypto, by all means. This is not investing advice. But I'm just saying if you have no views, the default weight in your portfolio for every asset is not zero. The default weight is its market weight, right? And so if you're just setting it to defaults, you should have some crypto. And the way to have some crypto is either you go create an account on Coinbase, or you just, own a total stock market index fund that happens to have some crypto.
So you're a market cap weighted guy.
I'm not saying that's the best way to invest. I'm saying that's the neutral way to invest. I'm saying that like anything that you do to deviate from like the market cap weighted global financial portfolio should ideally have a reason. Ideally. Not that I, follow that. I'm just, as a theoretical matter. Like you should own the market unless you have some reason to think that something else is better.
And that is investment advice.
No. I mean, I don't know how you could get sued over that, but no, it's not investment advice. The Bitcoin treasury companies are interesting in part because they give you a way to own crypto if your only investment is the total stock market. But more broadly, they're interesting because they are a way for equity investors to own crypto without owning crypto. And I think that there's a lot of demand for that. Some of it is from like Vanguard, right? Vanguard, which let's hypothesize does not want to own crypto, nonetheless owns a lot of MicroStrategy. It's like, that's like a good arbitrage, right? Like you have like Bitcoin, which like Vanguard doesn't want to buy, and you have MicroStrategy, which Vanguard against its will does want to buy. And so like you can like transport Bitcoin into Vanguard and make some money on it. But like more broadly, I think there's a lot of like equity investors who, for one reason or another, can or want to buy MicroStrategy for Bitcoin exposure, but can't buy like just Bitcoin for Bitcoin exposure. I get an email from one guy saying like, my hedge fund, our prime broker will give us 16-to-1 leverage on MicroStrategy, and they'll give us no leverage on IBIT, like the BlackRock Bitcoin ETF, right? So if you want to get exposure to Bitcoin, getting it in the form of a stock, like a real stock, not an ETF, like a corporate stock, getting it in the form of a corporate stock is in many ways preferable to other forms of owning it. And that's part of why the Bitcoin treasury companies often trade at a premium to their underlying Bitcoin, because like there's a whole class of investors who can get crypto that way, but can't get it as easily or as efficiently in other forms.
That's really interesting because after the spot Bitcoin ETFs launched, I think a lot of people, perhaps myself, questioned what the use case for MicroStrategy was.
Yeah. And the number one answer is index funds. Vanguard's total stock market fund does not own ETFs.
Yeah. It
owns companies. And MicroStrategy is still a company, even though it's a pot of Bitcoins. Like that's the number one answer. There are other answers because like someone at some prime brokerage is like, we'll give more leverage on corporates than we will on ETFs, even though the corporate is like more volatile than the ETF. But like the number one answer is index funds. And like, yeah, MicroStrategy is not in the S&P 500. It wants to be in the S&P 500. That's like that's the next frontier.
It did make it into the NASDAQ 100.
Yeah. And that's a big deal.
It was somewhat controversial.
Yeah, because like these indexes don't include ETFs. They don't include investment vehicles with like rare, interesting exceptions, right? Like there's like an argument that Berkshire Hathaway is an investment vehicle and like, and I don't know if you remember, but friend of the show, Bill Ackman of Perching Square Capital Management.
When he found his way into another episode.
When he was, so not the bird, but the actual Bill Ackman. When he was trying to launch. The
tennis pro.
Yeah. We haven't even talked about that.
No.
And we won't. When he was launching his closed-end fund, he was like, it's going to be in the S&P 500. It was not going to be in the S&P 500 because the S&P 500 does not include closed-end funds. But it does include Berkshire Hathaway because it's not quite a closed-end fund. It's a company. And MicroStrategy, same deal, right? Like if you're like, I'm going to launch a fund that holds Bitcoin, that will not be in the S&P 500 or even the NASDAQ 100. But if you're like, I'm a tech company, I'm going to almost exclusively hold Bitcoin and talk about it a lot, you can be in the S&P 500 or at least the NASDAQ 100. And that's different.
Well, that was the controversy around its NASDAQ 100 inclusion. The NASDAQ 100 does not hold financial companies. And it feels like MicroStrategy, it was MicroStrategy at the time, like was sort of grandfathered in because it is nominally still a tech company.
Right. Very nominally.
Yeah.
But that's the arbitrage, right? It's like, we're not a financial company. We're not an investment company. We're just a tech company that happens to own $70 billion of Bitcoin.
Yeah.
It's a good trade. I'm sorry that Bill Ackman caught so many strays at the end of this episode.
It's okay. I don't think he listened to the end.
I do want to say that, like, when we mentioned last week that we were going to name your bird friend of the show, Bill Ackman, we got approximately 20 emails saying of Perching Square Capital Management.
Yeah.
A lot of people came to that joke and we did not, and I'm sorry.
God. But very clever.
We'll do better next time. Perching Square.
Yeah.
He's learned to perch. And that was the Money Stuff Podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on Open Interest between 9 to 11 a.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net. Ask us a question and we might answer it on air.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff Podcast is produced by Anna Mazarakis and Moses Andam.
Our theme music was composed by Blake Maples, and Sage Bauman is Bloomberg's head of podcasts.
Thanks for listening to the Money Stuff Podcast. We'll be back next week with more stuff.